All right, good afternoon, at least here on the East Coast. Good morning, good evening, I guess depends where you are in the world. And we've got people around the world here. Just before I go too far, let's just do a quick audio video slide check here. If you don't mind, just type a Y in the, I guess it's the question box there in GoTo, and just let me know if you can hear and see everything okay. All right. All right, Bruce says yes. Chuck, Mike, Blair. Okay, perfect. All right, so we'll go right into it here. So officially, welcome everyone. And thank you for joining us today for our webinar, Master the Art of Spread Trading, hosted by FFR Trading and featuring our esteemed guest, Joe Duffy. We're excited to have you all here. I believe today's session will be a game changer for many of you. My name is John Madison, by the way. I'll be leading today's presentation. And as a reminder, those that stay until the end will qualify for an educational trading pack from Joe and FFR worth $350. So be sure to stay till the end. Let me put up what we're going to be covering today. Obviously, we'll do an introduction to who we are here at FFR Trading, what our role is. I'll introduce you formally to Joe Duffy, the man of the hour here. We'll get into his couple of his strategies that he's using to navigate the volatile markets here as of late. And he'll give his presentation. That'll be the art of spread trading. We'll do a Q&A when Joe is done there, so you can ask Joe some questions directly. And then we'll give you a summary of all the course details and the exclusive offer that we have ready for you guys, those who are ready to take that next step with Joe's programs. All right, so before we go too far, the risk disclosure, okay? You guys, I think everybody's aware, trading involves risk. It's important to understand these risks before you dive in. Results are never guaranteed, right? You've heard the saying, no guarantees in trading. It's essential to only trade with funds you can afford to lose, and nothing we discuss here today constitutes financial advice. Rather, it's for educational purposes to help you make informed decisions. And that's the whole reason, FFR came about. Because, FFR Trading, we go back to, I think it's 2006 now. We are a boutique research and due diligence firm. We are dedicated to evaluating top-performing trading systems and investment strategies. Our mission is to connect small retail investors with reliable trade signals and systems from seasoned market professionals like Joe. We're helping you, we're trying to help you achieve your financial freedom, your true financial freedom. So here at FFR, we represent a select group of professional market traders, each with over 15 years of experience from stocks, options, Forex, futures, commodities. Each trader we partner with has a proven track record, averaging over 100% annual returns in their specialized programs. So we take pride in our rigorous 8-step certification process, ensuring that only the most successful and trustworthy trading systems make it to our clients. So whether you're a retail investor or an institution, FFR Trading is here to give you access to real, effective trading systems from professionals like Joe who understand the markets inside and out. So let me go ahead and bring in our esteemed presenter here. Before I do, here's some of our team here at FFR. Michael here, some of you know pretty well. He's done these presentations in the past. He is the president and CEO of FFR Trading. And then some of our extended team, some of our strategists. So if you do call us, you can speak to one of our strategists who are all well-versed in the markets in general, well-versed with the traders that we work with and their strategies, so they can really help you make sure that you find a strategy that is a great fit for you. All right. So let's go ahead and bring in the man of the hour here, Joe Duffy. Joe, good to have you here. I know every time we do these, you're usually on vacation somewhere. Where are you at today?
I'm at home in my office.
Which is Toronto, Canada, correct?
Yeah, just outside of Toronto, yeah.
Okay.
Actually, probably a little closer to Buffalo, New York, actually, yeah. But yeah.
Oh, wow, okay.
Yeah.
Well, you're getting, the weather is probably turned up there. I don't know if you've gotten any snow or anything yet.
Well, no, it's not quite that bad. Actually, we golfed on the weekend, so it's not too bad.
Okay, all right. So it sounds like pretty good
Yeah,
weather still holding up there.
yeah.
Um, Now, instead of me just kind of reading through your bio here, which is impressive, and I like to do it, maybe just cover the highlights, the high points, what you want folks to know about your background, and why we should be listening to you.
Okay. Well, I guess it's mostly written there. I mean, it's. I guess I got started in the business through the United States Trading Championships, which Norm Zader ran quite a while ago, and I guess he's resurrected them, and they're on again. But they got a lot of coverage in those days in Barron's and big publications like that, and that's where Paul Tudor Jones got started, and a lot of names that Trout, a lot of names that became huge in the industry got started there. And then I went to one of the international banks, and I was on the prop trading desk where we traded the bank's the bank's account and risk. And when I left there, I got into market ladder and doing things that allow me a little bit more flexibility. With, as you said, I can do it from anywhere. So in the winter time, I'll be leaving for Palm Springs, not too distant future, so our winter there, and I still love doing it. One of the things I love really doing, I'll probably talk about this a little later, is every morning I do a video, and I really like that. It just, I don't know why, I love doing it because I think me hearing what I say, it helps me during the day, I think, and I get good positive feedback from it too. But so yeah, that's what I'm doing now, just on my own and trying to help other people, with some knowledge.
Fantastic. Now, Joe, you've been doing this a long time. You really could partner with anybody, and I wanted to ask you why did you choose to partner with FFR?
Well, I really like Michael. We've had a pretty good relationship, and there are things where you have to trust the other person, and I trust Michael and you, yeah, that's basically it. There's never been any end runs or saying one thing and doing something else. So it's just integrity, I guess, is the way to sum it up.
All right, fantastic. So much appreciated, and obviously we enjoy very much working with you. And I was just thinking about it. You and I have been doing webinars for FFR here. It's going on, I think, 5 years. But you go back even farther. How long have you been with FFR?
Ooh. I think, I don't think much longer than 5. It could be a little bit longer, but it seems about the right number for me. Yeah, I mean, I talked to some other people. There was a similar operation I talked to, just it didn't have the right fit. So, but I think about 5 is the answer to your question. Yeah.
Yeah. I know it's been at least 5. Yeah. So it's been quite a long time. So, and in that time, you've got a background creating indicators, which we're going to take a look at in a bit here, that you use for Target Zone, the different programs. Obviously, you've taught your strategies and trading in general, options, and you've got a pretty extensive coaching career as well. Let's get into the programs here, and we'll start here with the Target Zone option program. So Target Zone is a program primarily focused on debit spreads, correct?
That is 100% correct.
Yep. Okay. And using options on stocks and ETFs. It's built around your proprietary scoop indicator, which we're going to take a look at in just another slide here. And it identifies, high probability trades with some very precise high probability trades. There's an average of 4 to 6 trades per month, and you have different exit strategies that we'll probably get into there as well. Anything you want to add to the Target Zone program? I know you're going to do a whole kind of presentation on it. So, but anything I missed that's important there?
Not really. Are you going to talk about what quantum AI is, or do you want me to tell you the difference, or do you want to do that?
Well, let's talk about quantum AI, and then maybe you can point out the differences between them if they're not obvious. Now, quantum is a newer program to our clients anyway. That's buying straight puts and calls, and it is basically, I think you said in our discussions earlier, it's 100% AI doing the
100%.
Yeah.
Yep.
And it does
There's no
focus
Joe
on
factor, whatever. Yeah.
So it tells you what to buy. Do you have any discretion on which option to pick, or does it even give you that?
Normally we're paying something in a price range, so that it's not, we're not going to buy $15 options on Tesla. You know? So we're picking options that are $2 to $8 somewhere in that range. So depending on where that lands on the scale. Yeah.
Okay. And this also averages about 4 trades per month, and the holding period for this from a few days to maybe a month out, I think you had said earlier.
Yeah, they're about the same in that regard. Yeah.
And you were talking about how you kind of utilize these two strategies. They kind of go together, right? They kind of complement one another. Talk about that a little bit.
Well, the target zone is by its nature just a little bit more conservative. Sometimes you even give up some potential gain for your conservatism, I guess, which is the nature of spreads in some cases. Sometimes it can work to bail you out fantastically, and sometimes it can actually cut into your P&L a little bit. And I say it cuts into your P&L a little bit only when you're profitable. When you're losing money, it's a big bonus. Now, quantum AI is just straight puts and calls, so it is just a little bit more aggressive. So it can go through periods where it's hotter and it makes more money than target zone, whereas target zone's a little more plodding. So together, they kind of tend to smooth each other out. And as you said, to mention again, quantum is completely AI. Yeah, you work the signal off the computer at the end of the day and you execute it. And target zone is a little bit more, there's a strategy involved with it, but there's also the Joe factor, and especially when choosing which options to pick for spreads. And I'm not going to get into this part of options trading, but options are always not efficiently priced. And I will talk a little bit about this, but sometimes when they're not efficiently priced, there are strategies you can use to take advantage of that. So target zone does that as well. Whereas quantum obviously doesn't. Yeah.
And with target zone, I know depending on market conditions, you're not locked into spreads. There are times where you might buy a straight put or call, or at least initially, and then maybe kind of leg into a spread from there. Or
absolutely. 100%.
So you got total flexibility with that.
Yeah.
That program.
Yeah. And just to get that point out too, because I know some options spreads are new for some people, and find a little bit more difficult than just switching calls. You're never locked into a spread. Even if I have something that expires in January and another leg expires in December, I can take it off today. There's no problem with that. All you're looking for is that spread to widen. So you're never locked into a spread.
I'm going to pick up a question from Richard here. We'll do a Q&A after you've done your presentation, but because what Richard is asking kind of goes along with this. He's asking basically what level of options approval basically to need from the broker. I was a broker with Schwab, so I can tell you it's what they called level 2. You need a level 2 options approval for spreads. But this is something you can do in an IRA, correct, as well?
Well, you know what? Again, not being an American, I wouldn't want to touch what your regulatory issues are with that. I do not believe in Canada in a retirement account you can do it, but in the U.S. has different rules for almost everything. So you would be better to answer that question than me, to be honest.
Yeah, so I believe we do have clients that are trading these programs in an IRA here in the U.S. anyway as well. So let's get into the performance of the two programs. Now, the target zone options, right, this is going to be roughly based on a $10,000 account size. You're allocating between $1,000 to $1,200 per trade. These numbers are non-compounded. Now, Target Zone has been active since 2019, whereas Quantum AI, I believe, is 2022. Right. So obviously, Target Zone's got more history behind it, and you can see the numbers here. It's averaging 17% a month. So when we go through these numbers, those of you watching here, think about what these kind of numbers would do for your IRA or your retirement or your trading in general. It's averaging an annual average return of 199%. It wins 75% of the trades, and this is what I love about your strategies. You have a high win percentage, but if you look at the average win is also larger than the average loss and a profit factor of 4.21. So these are pretty fantastic numbers, and as you said, it's a little more conservative strategy, a little more plotting, but it's a good tie-in together with this Quantum AI. So any other points that you want to bring out with Target Zone, Joe?
No, I think that you've done a good job covering it, John. Yeah.
Oh, thank you very much. And then Quantum AI. Now look at the monthly average here, 51%. The annual average return, 606%. Again, high win percentage, winning 77% of the trades. And the average winner, $602, with the average loss just $265. So it's about, the average win is about 2.5 times the size of the average loss, it looks like, which is phenomenal with a 77% win rate. And the profit factor, you can see just blowing things out of the water here. Anything you want to add about Quantum AI? I know this is a new program to me. So anything else you want to add to that?
I don't think so, John. I think we covered everything pretty well.
All right, perfect. So let's get into, Joe, your scoop indicator. So this is a proprietary indicator that you developed over the years, and you use this for lining up your trades and picking direction, picking your entries, your exits. So maybe walk us through. I've got a slide up here, Joe, if you can see that. And maybe just kind of go over the components of this. And again, this is something that you're using as part of your Target Zone, right?
Right. Just let me say this before I get started here. I got a new camera yesterday, and it right now it seems fine, but I've noticed it has been a resource hog when we started just a practice session. So if I'm breaking up with my voice or anything, let me know, and I'll disable the camera. And I haven't got my charts up right now, so there's no resources being used there. And so it may happen later when I have to pull the charts up. So just let me know. Second thing, I've got the camera angled a little bit profile when I adjust the charts, because otherwise it'd be too glary because of where my office window is. Okay, so you're going to get a little bit of profile if that's okay. Okay, so this is pretty simple. Basically, when the colors are blue, like you can see, I hope you can see my cursor on this chart here as it follows along. Basically, all these lines here are under the price, and they're supporting the price. And you can see when price came back, it was supported here, and it came all the way up. And I've color-coded them all blue. So that's the times I want to trade long. And then when they start to get over top, as you can see, right, not too far off the top, things started to change, and now they're all red, and they're following the price down, and vice versa, going back up to blue. So basically, the first thing you want to do is you want to determine your directional bias. Are you long or short? And so that's step number one. And as I'm often fond of saying, it's never if A, then B. Nothing is ever that simple in trading. So we'll go to slide 2, and we'll combine step 2. Okay, on this one here, you can see the histogram, which is the blue vertical lines. That's the histogram. When it's above 0, much the same as we did on the previous slide, you generally want to be trading long. Okay, so if I've got a blue histogram above 0, and my red scoop line comes down below 0 and turns up, that would be a buy signal. So as you can see where John's highlighting the cursor, I've put little blue arrows there where price and the scoop oscillator and scoop histogram match up. So when it's above 0, the red oscillator goes below and turns up, that's a buy. And I've marked that little arrow on the price. Okay, and it will be the exact same for going down. If you go over to the right of the chart, you see the histogram made it below 0. And now when the oscillator goes above 0, the red oscillator and turns down, that's your sell signal. Okay. So chart number 3, we're going to combine charts number 1 and 2 together, and you can better see what we're trying to do here, which is buy dips in the trend. So those blue arrows are the same ones that were on the previous chart where the scoop signals were. So as you can see, what we're trying to do is buy the blue arrows within the uptrend, right? And the second third of the chart there, we're trying to sell the red arrows within the downtrend. So that's the most effective way that I've found to trade. Find something that is halfway trending or likes to trend, and then wait for your signal to buy a dip in that trend. I don't like buying breakouts too much, but I do like finding established trends and then buying dips in them. You have a lot less risk that way. Just look at it as simple as this. If in your own trading, you know what RSI is probably. If you never bought when RSI was, unless it was below 50 or unless it was below 30, and you absolutely never, ever, ever bought if it was above 70, you'd be surprised at how much just doing that would keep you from doing the things where you're chasing the market. So I much prefer to buy the dip, and this is how I do it.
And this is a fantastic set of indicators. I mean, you can look at the buy points here and the sell points. Those would be some excellent profit opportunities on those. Soman, these indicators that Joe is showing are his proprietary indicators. We're just showing them so you can see this is a tool that he uses as part of his target zone options to this is, I think, advanced micro devices. So, maybe Joe is setting up a spread, based on these signals, and it's one of the tools that he's using as part of that program, which as a subscriber, you'll have the benefit of having this working for you as well as Joe. All right. Anything else on the scoop, Joe, before we move
No,
and get ready?
Hopefully it's pretty visually intuitive for people. I don't think they really need to understand all the logic, but you can see, hopefully it's visually intuitive and that you can understand, okay, here's what he's doing.
And Joe, do you have, somebody was asking about time frames, do you have a specific time frame that you focus on with this? Or does it
usually daily.
Any time frame?
Well, it works on any time frame. I'm using it on 2-minute charts during the day.
Okay.
But generally, I'm looking at daily charts for a target zone because you want to have enough movement to make it worthwhile in the options. Like during the morning video, sometimes I'll do quarter day or half day charts if I'm talking about moves that may last a day or two. And if the subscriber wants to do them on their own, well, here's what I'm looking at. Okay, and you may only get a $2 or $3 move out of something like that, but it's certainly enough to trade it if you wanted to. But generally, I'm looking for daily, or sometimes even I'll make a chart that has 2 days per bar or 4 days per bar. So I'm generally looking at a little bit bigger time frames, so that we have a little bit bigger potential move, forthcoming.
Right. All right. Perfect. All right, so I'm going to get ready to switch over to you, Joe, and Joe's going to walk us through his insight on spread trading, his kind of his unique twist on it, the key elements of his target zone option program, giving a first-hand look at the method and how he analyzes trades, and I think you've got some recent trades that we're going to take a look at as well. So after Joe is done, we'll come back, we'll do a Q&A. And so you guys that have questions, go ahead and, keep submitting them. I'll get back to them when we get to the Q&A portion. So Joe, I'm going to just switch over to you and make you the presenter here. You should get a little pop-up on your end.
Okay,
Okay.
so option spreading, and I know that spreading sometimes people, you have to get level 2 as you mentioned, and they would just rather do puts and calls, or they don't understand the spreads. Uh, it's just kind of, sometimes it's like, driving a car that only turns left. You can probably get where you're going, but sometimes it's a little harder. So spreading allows you better risk control, a smoother equity curve, higher win percentage, more flexibility for sure. And the most important part is, as we all know, when you buy an option, the worst part is the time decay. Every single day it loses a little bit of value just by the passing of time. So one of the things that we try to do in spreading is essentially put ourselves in the position of the floor trader. Floor traders don't make money by betting on the direction of the market they're trading. Floor traders make money by selling options to whoever wants to buy them, and they receive that premium. So they're the ones that are actually benefiting that little bit every single day by that erosion of time value. Okay, so what we want to do is put ourselves in that position. Okay, so that's what option spreading is really most about. Now, this is the most important chart I'm going to show you today, and it shows you how the non-linear decay of the time value on your option is. So, and time value, just, I know some people or most people are going to be familiar with this, but if we buy an option that has a strike price of 100 and we pay $5 for it, that option really has an intrinsic value of 0, because it's the right to buy the stock at 100 when the stock already is 100. So it has a value intrinsically of 0 and a time value of $5. So what's going to happen to that $5 over time? And this is a 90 to 0 scale, but if you went out 6 months, this line would be very smallly sloped. But you can see how the curve of the time decay curves exponentially down until expiry. Okay, so our $5 option that has 90 days to go, when it has 60 days to go, it may be worth 4. Okay, and then when it has 30 days to go, it may be worth 2.5. But then as it starts to get into 20 and 10 and 5 days to go, it increases exponentially towards 0. So basically the way I look at this, Brad, is we want to take advantage of this time decay here. So as it moves towards 0, that's paying us. Okay? It's not working against us. All right. So that's the essence of why the spread is a good tool right here. The slope of this curve and that fast time decay that we can get to work for us is essentially why I like trading options with spreads. Okay, now, again, I'm going to go through a couple of things that are maybe basic to some of you, but I just want to touch on them briefly so the people that are more new can get an idea of what we're doing. So essentially, a spread is like a covered right. Now, if you're at all familiar with options, you know that you can buy XYZ stock for $100. Then you could turn around and sell that option for $5, expires in 90 days. Now, what that does is you've sold someone the right to buy that stock from you for $100 in the next 90 days, and they're going to pay you $5 for that privilege. Now, if they exercise that privilege, you have to sell them the stock at 100, but you've gotten their $5, so essentially you've made $5 on your transaction. If the stock ends up below 100 and they don't exercise, well, you get to keep the $5. So essentially a spread is like that, but instead of owning the stock, what we're going to do is own an option that's far dated. Okay, so if instead of what we might do is own an option that's 4 months out and sell an option that's 2 weeks out. So that 4-month option takes the place of our stock in a covered right, and the short dated one is the one we sell against it. So the key takeaway, time premium always erodes faster on the short dated option. That's the key takeaway for options spreading. So I'm going to start off with a simple example. I don't do that many calendar spreads, but I do actually what would be called a diagonal calendar spread. So I'm just going to explain a calendar spread first so we can take it step by step into how the diagonal would look. Okay, so I own the long dated. As I mentioned before, that long dated means, in our example, let's say March. So I own a March call, and I'm going to sell maybe a December 1st call against it. So that's how I set my spread up. I'm long in March and short in December. Okay. So in this example here, well, this is a really close example that I've given. This is a very small short-term example. I could buy the November 400 call at 5, and I can sell the November 15th 400 call at 2. So I already recouped $2 of my $5 cost by selling that. Now, if in 3 days or 4 days when this November 15th were to expire, it would be zero if the stock stayed at 400. Okay, so now I've got a cost of $3 and I still own a 400 call. Okay, so while this loses the whole $2 of premium, assuming the stock stayed at 400, then down to 410 or 420 or something, because it's not going to erode, or maybe 4. It's not going to erode as quickly. So if I lost $1 here, I'm making $2 here. Stuff's changed, and I'm up $1. Okay, if I wanted to take the whole position off. Okay, so that's how essentially the short
Joe,
call.
Joe, just do me a favor for the integrity of the. Go ahead and shut off your camera because it is interfering.
Okay. All right. Sorry,
All right.
guys.
I apologize about that, guys.
Yeah. Okay. So just to reiterate, I guess the important part, if it was breaking up, is that we're taking advantage of that short dated call. John, this option or this chart here, was it breaking up when I did this chart? Because this is really the whole part of
No,
that was good.
The slides okay. Yeah, it was just your voice was breaking up.
Okay, but did the explanation come through on this part? Because really, this is the essence of what we're talking about today.
Yeah, definitely.
It's fine. Okay, all right, good. Okay, we'll proceed then. Okay. Okay. Now we're going to do moving in from the calendar spread to diagonal color calendar spread. So I'm going to buy a February 100 call, an XYZ stock at $8. Okay? And I'm going to sell a December call on XY 100 call at $2. Okay? So this is the calendar spread still. Okay? So if I've gone out here to February for $8, I can sell the December for $2. So just like a covered right, except this long February is actually my stock, and this is the call I'm selling against in December. Okay. Now, if the stock stays at 100, what happens? This goes to 0. Okay. This is maybe going to go because of the way the exponential curve goes for option decay. This may go to 7.5 or $7.40 or something. So I'm going to lose 60 cents here and make $2 here. At that point, I could take the whole thing off if I wanted. However, let's say the stock goes down a little bit and this thing just expires and it's at 98 and I still like it. Well, then I could sell another one. So I've already recouped $2 of my 8. I might be able to sell another one for $1.50, depending on where the stock is. So now I recoup $3.50 of my 8. Okay? So you can see even if I'm end up being wrong, before I have to admit I'm wrong, I'm going to collect some money. And if I'm wrong, I'm going to collect all of that money if the stock goes down. Now, I'm still going to lose on this, but I'm going to win on this leg. Okay, so I'm going to win on the short leg, which is much better, as we'll see with some examples in a moment, than just having the straight call where you're just going to lose. Okay, here we come to the diagonal calendar spread. The calendar spread is the same strike price as different months. The diagonal calendar spread is different strike prices and different months. So I'm going to buy XYZ February call at $8. Now this time I'm going to sell, instead of the 400 call, I'm going to sell the 405 call at $1. So if the stock's around 400 right now, this is $5 out of the money. So for that to break even, the market would have to go to 406. Now, if the market goes to 406, my $8 call is probably going to go to 1050 or something like that. Right? So I'm going to break even on this and make $2.50 on this. Okay? If the market goes to 403 or 404, this option may go to 9.5 or 10, and this is going to expire worthless. So I've made $1 here, and I've made $1.50 or something on this one. Now, if the market goes down, and it goes down below 400, obviously this 401 call, 405 call isn't going to be worth much, but it has given you at least $1 profit, which will offset whatever this $8 call goes down. So if it goes down to say $5 and I go, okay, this is wrong, just let me out, I lose $3 here, but I gain a third of it back here on this $1 call. Whereas if I just had the straight call, I'm taking a 40% loss, and now I'm taking, a third less of a loss because of this call spread against it. So if it goes up, I can make money on both sides, but if it goes down, at least I have some protection. So I'm going to go through some various scenarios now about we buy XYZ stock, what happens if it goes up? What happens if it stays the same? What happens if it goes down? So in this example that as I just used, we're going to buy the 400 calls for $500, for $5. Okay? And so in February, this might be January or something. It's a little less priced. And I'm short 405 for $1. Now, if the stock stays, let's say that this had a week to go, right? It's a volatile stock. It's $1. It has a week to go. And the market a week from now is still at 400. Well, this 405 is worth 0, so I pocket that. Okay, this long call that I paid $5 down goes down maybe 75 cents because remember, it's still got time. It's not going to erode nearly as fast as this $1 did. So I've lost 75, but I've made $1, so I'm up a quarter. Now, you may not think up a quarter is very much, but just remember, I bought this option spread thinking the market's going to go up. And the market didn't go up, it went sideways. And it didn't cost me anything. Not only that, now I can sell another 405 call if it's unchanged and sell the next week for another $1. So I've mitigated my cost by $1 the first time. Now I've mitigated my cost by another $1. So this long 400 calls now instead of 5 is only cost me 3. Remember, those $2 are in my pocket no matter what. And we'll get to what happens if it goes through a 405 in a minute. But those $2 are in my pocket no matter what. Let's deal with a scenario where we're bullish, so we're buying the calls, 400 call, and we're trying to sell the 405 call just to offset our cost a little bit. But we're wrong. The stock goes down to 395. Okay, well, clearly that 405 call that we bought, that we sold for $1 is getting sold. So if the stock goes down to 395, we're back for 25 cents. Well, maybe 75 cents on a $1 call I sold. Now I'm going to sell a 400 call. So what I've done is change this from a diagonal calendar spread just to a straight calendar spread because the diagonal is the 400 to 405. See, they're not the same, but now I've changed it to a 400 to a 400, so it's straight a calendar. So I'm going to sell this one now for $1 because with the stock at 395, it's where essentially the 405 was when the stock's at 400. So I'm going to sell this for $1. So I've now mitigated. I've got a 75% cent profit here, and I've sold this for $1. So now I've recovered $1.75 of my $5 400 call cost. Okay, so does that take me out of the woods? It means I won't lose money? No, because if the stock keeps going down, I'm going to have to sell this thing, and let's say I sell it at 2.5, and this thing hasn't expired yet. I may have to buy this back at a quarter. So in that case, I'm going to lose 2.5, make $1.50. I'm going to lose $1 on the whole thing, or 20%, a dollar of $5, but since I've mitigated my loss to say $1.50, I've lost 50, made $1.50, so I've actually only lost $1. Okay? Whereas if I just had this 400 call and I said, oh, it's 250, I'm going to cut it out now, I've lost half of it, I would have lost 250. But by strategizing with the short dated calls, I'm at least able to mitigate some of my loss. Okay, it's not a panacea where you're never going to lose. It helps you mitigate when you are wrong. Now, if the stock goes down, well, actually, I just went through this scenario. The stock goes down further, and I have to cut my $5 option out, so I lose $2.50. I buy back that 400 call at a quarter, so I make a 75 cents. I've already sold and purchased back again the 405 call, so I made 75 cents there. So lost $2.50, win $1.50, total of $1. Okay, that's 60% better than the 400 call position if I left it all alone. So it's $1 loss versus $2.50 loss. Okay? That's what I like spreads. And this particular diagonal spread is what I like. Now, let's say that we're really right and the stock rises quickly to 410. Now, I would mitigate something before it got, as soon as it started to get to 405, I would do something. But let's say that it closed at 404 and the next day it opened at 410, which is a completely plausible scenario, and we didn't have any chance to mitigate that 405 short. Okay, it's not going to kill us. We're still going to make money. We're still making money, but this is where sometimes you're going to make less. So the long dated call that we paid $5 for, the 400, it rises to $11. So we're up $6 in there. And the short dated that we sold for $1, now it rises to $5 because it's a 405 call and the price is 410. So at expiry, it's going to be worth $5. So we're going to lose $4 there. Okay. So we're still making money. We made $6 on the long dated, and we lost $4 in the short dated. But remember, we also collected the profit selling those two options. Remember, I said once you sell that short dated option, that money's in your pocket. You don't have to pay it back. Okay, so even though we had to buy the option back at $5, we get to keep that first trade, but which you made 75 cents on, and we get to keep the sale that we sold it for $1. Okay, so we sold it for $1, had to buy it back for $5, but we still get to keep the $1. So therefore, what do we have? We have credits of $11, $1, and actually that should be 75 cents. So it should be like $12.75. And we have debts of $5, which was our initial cost to buy the 400 call. Then we have to buy back the short 405 the first time for a quarter. Then we sold it again for $1, but we had to buy it back at $5. So totally, we have to pay 10 1/4. Okay. Now, this is a scenario where, hey, if you just bought the 400 call and held on to it, you made it from $5 to $11. You'd have made $6. But it's not a scenario that happens very often. And so in this case, you're going to make $2.75. So you're making less than you would have had you had a straight call. So that's the worst case scenario that can happen to you if the market moves too rapidly and you don't have a chance to mitigate. Now, I said chance to mitigate. I'm going to show you what I mean by a chance to mitigate, because there's a million strategies here that we can use with option spreading. And one of them is what they refer to as rolling out that short call. So that means that we buy back the current short dated option. Remember, if we sold it at $1, we could buy it back maybe at $2, and then another week out, and I sell it at $3. I sell the next week at $3. Okay? So, or I can go, I buy that 4 or 5 back at $3. Remember, I sold it for $1. Oops, the market's going up. Let me buy it at $3, my $2 loss. Now I'm going to buy a 407 another week out, or sell a 407 another week out for $3. So this is a wash. All essentially I've done is, instead of being short the 405 Now I'm short the 407. Okay, so that gives me a little bit more room of profit on that 400 that I'm long in the far dated. Okay, so that's what I mean by ruling out or mitigating things. Because this erosion time value is always working for them, this will not go up as fast as this one, the 407 one, because it's further out. Okay, so, okay, I hope this is, I know it's hard to see this without a graph, and hopefully I'm going to get to a chart where we could actually talk about this. If you've never been through it before, these numbers can, I know, just start spinning around in your head, but hopefully we're following well enough, at least the principle of it. And remember that chart. Remember that chart of exponential time decay. That's really what we're doing here. That's the whole key to everything. Okay, so again, if the market went up to 410 in expiry and we rolled it out, okay, we rolled out to the 407. We initially bought that call for 5. Then we sold. Then we had to buy back that 405 that we sold for $1. We had to buy it back at 3, and we received. And we had to buy it again back at 3 if it ended at 410. Okay, because that 407 would now be worth 3 at expiry. So we paid 5. We had to buy back the 405 at 3, and if it ends at 410, we'd have to buy back the 407 at 3. So paid out 5.3 plus 3 is $11. Okay, so initially you received that 75 cents for the first one. Then we received $3 for that second one that we rolled out here, and so we received in $3.75, and then we sold our long dated call for say $10.50. Okay? So the 400 would have gone up to $10.50 at least if the call is 400 and the option expired at 410. It's worth $10 plus at least 50 cents time premium. So the payouts or the received ins are $4.25. So we pay out $8 and we receive we pay out $14.25 and we receive we pay out 11 and we receive 14.20. So we make 3 1/4 if it ends at 410. Okay? And I'm trying to give you various scenarios here of what will happen at various strike prices, because different things are going to happen depending on how the stock moves. Now, remember, we're short at 407. So if instead of ending at 410, it ends at 407 right on. We still paid out 5. We paid out 3 for that to buy back that first call. And the second call is going to expire at 0. So instead of having to buy it back at $3 when it's 410, at 407 it's worth 0, so we don't have to pay anything. We have that's when we have to pay about $8 to flatten that. And we received the 75 cents, the $3, and now because this is a 407 option, and we have long the 400 option, it's going to be worth about $8. So that's about $11.75. We paid out $8, so our profit's $3.75. Okay, so I'm long Chevron back in here somewhere. Okay, you can see where my curve is, and I'll actually put little lines on this chart here. So I'm long Chevron back 150-ish. Okay, right where the line is, somewhere back in here somewhere. And I buy the 150 call. And I expect Chevron to do what it eventually did, which is go up. Okay? So the 150 call, whatever, cost me, I don't know, $7 or something out for January when I bought it back in October. And what I did was I sold an option that expires this Friday, actually, on the 160. And I received, I don't know, $1.50 or something for that one. So I sold a call up here, strike price of 160, that is going to expire right now, actually. So let's move this chart way out, because the I'm in is out here. It doesn't expire until somewhere around here. Okay, that's the option I'm long. Okay, so I'm long this option at 150 that expires out here, and I'm short an option right here at 160 that expires on Friday. Okay, and I received whatever, $1.50 for that. It appears very likely, although not impossible, that that 1.5 is going to just expire worthless, considering the option 158 right now. So it would have to make up a couple dollars to get in the money. However, don't really care if it does, because along the 150 here at like $7 or something, worth about 10 each right now. Well, I'm making $3.50 on this option, and right now I'm making $1.50 on this option, so I'm making $5. Where I just had I've been long the 500 or the 150 call, I'd only be making $3.50. So you can see I'm on both ends. Right now, if I really thought everyone was going up, what I could do is buy this 180 call back for whatever is probably about 75 cents, 65 cents right now, because it only has 2 days of expiry. So remember, I sold it for $1.50, so I'd be making 75 cents on it. And then what I could do is I could sell one if I'm quite bullish. I could sell another 160 actually if I wanted to. And I buy this one back for 65 cents and sell another for $1.65 or something. So put another dollar right, or I could sell a 162.5. Right? So I buy this back for 65 cents, and I may sell the 162.5 probably for the same 65 or 75 cents. So those are a wash. So why would I do that? Well, this 400 call that I'm long has to, sorry, this 150 call that I'm long has to get through 162.5 before that option I'm short's worth any money. And so if it does, at 162.5, that 150 call is going to be worth like $13. So that's why I would do that. So I could either just take it off, or I could roll it up if I wanted to the next price. And then if the market rolled over, wanted to go down again, I'd say, okay, I'm going to buy this one back here, make a very small profit, and I'm just going to take my profit from right here on my long call. Okay, so we have several options that we can do. This is a trade that I'm actually in right now. Okay, so that's the advantage, and you can see if it doesn't get to 60 by Friday, 2 days from now, then I'm just going to pocket whatever I sold this for when it was back here. And I'm also going to profit on the rally from back here up to where it is now, right here. Okay, so I'm going to profit on both ends of that. Okay, and why am I going to do that? I sold this for $1 or $1.25. I can't remember what I sold it for. It's at its exponential decay part, where if it doesn't get through 160 in the next 2 days, then it's going to be zero. Okay, so I pocket the whole thing. But of course, if it keeps going up, this one's going to go up even more. So it's like a win-win at this point as you get to close to expiry. Okay, so selling it for $1.25 back here. The guy who bought it also thought the market was going to go up, but it didn't go up fast enough for him. So I make money on this 400 one at the distance. I also make money on the short one I bought right here. Okay? We did a ton of this on TLT, the bond ETF that was rallying, and we sold 3 or 4 times options that were expiring the next week, and just kept going out and going out and going out. And eventually, I had recovered the entire cost of my initial fire out option by the time I'd finished selling stuff that was to expire. Okay, so that's how it works in a real-time example, and one that we're in right now, and that we'll be getting out of in the next day or two for sure. Okay, that's it. I hopefully with the chart and the graphic, it's a little bit more clear to understand exactly what we're doing. I know sometimes it's a jumble of numbers and me trying to talk. It's not always as clear as it will be if you can actually see what we're doing here with the chart. So turn it over to any questions or comments or.
Yeah. All right. Thanks, Joe. Fantastic presentation. Like I said, unfortunately, the internet issues there. So Richard wants to know, how does assignment risk factor into this?
Yeah, well, that's a really, I'm so glad you asked that, honestly, because I know everybody gets afraid of that. And really, it's, what happens is, so if you're short the option, you can get assigned on that option. Remember, for those of you who don't know what that means, when we go back to the example that I initiated this webinar with about the covered call, you own stock, 100 shares of stock at $100, and you sell a call against it at $5. They can, you have to give them your stock. If it goes back above $100. So if you're short the option, somebody can, if you're going to be responsible for that stock. Okay. So if you get assigned on an option, all you do is the next morning, you simultaneously liquidate that stock and liquidate the long option at the same time. It's no different. It's zero difference between liquidating the stock and liquidating your long dated option as it is just buying that option back and liquidating the long option at the same time. Because that's, in fact, it may be even a little bit better because there's no option time premium on on stock, right? It's just the intrinsic value of it, whereas sometimes in the option there's some time value. So the next morning, if you get assigned, you will liquidate your stock position, you liquidate your long option position, and the position's done. As long as you do them simultaneously, there's no added risk. People get nervous sometimes because they see a big number, but remember, every option is 100 shares of stock. So if you buy one option on Tesla, you're actually controlling $33,000 worth of stock. So if you get assigned, people say, oh, well, I got assigned $33,000 worth of stock on one option. Well, yeah, because you're controlling $33,000 worth of stock on one option. That's fine. So the next day, if you ever get assigned, simultaneously exit the stock, exit the long-dated option. It's just the same as buying everything back. It's exactly the same as buying the option back and liquidating the position.
So let me try to get Anita's position. She's in TLT. She's got the 98, 97, 94, and 90 long calls, expiration from March through September of 25, and she's trying to figure out how to mitigate.
Yeah. Well, I think you have to mitigate. You can't mitigate down here, I don't think. TLT, I had thought was probably not going to go below. I'll be really blunt about that. And I say it in my video every morning. I said, hey, guys, I didn't think this was going to go this low. So that was a bad call. As the market moves up, you can start to sell some things against it, but you have to sell it on a rally. You can't sell it down here. You're just... if you're long at 94 and you sell at 94 against it, you can do that. But at this point, you're not going to get enough for that 94 to mitigate very much. So you've got to wait for a rally where at least you can get something, dollar-wise that helps you mitigate that 94 option that you're on, March or whatever. Okay, but at 90, it's not worth enough to help you much. Okay, and yet you could sell a 90, but that's 50 because if it goes to 94, now your 90 is getting killed, right? And you're not making as much as on your 94 call as you're losing on your 90. So I would not recommend you do that. I think that what you want to do is just in general, and this isn't specific to your situation, but just as a general principle, you want to sell at least an equal strike to the one you're long. And in this case, with TLT, it's going to have to rally somewhat in order to be high enough price to actually, help with any mitigation.
Okay, and yeah, I think that's about as good as you're going to be able to do in that scenario. So some other people reporting issues with internet in Canada here. Robert wants to know, how does an option spread not lose money if the price of the underlying goes down?
Oh, it does. And we went through the scenario. Let me. I'm loath to bring up these charts again, but let me see if I can. Okay, we definitely have scenarios where you can lose money. What happens is you can mitigate your loss. You can help. When I say mitigate, I don't mean eliminate. Okay, to address your scenario, because it's a good one, and mitigated does not mean eliminated. So if I bought a 400 call at $5, and it's February, say, and you might want to just jot these numbers down, and I shorted a call of 405 against it for November for $1. So I'm long February at $5, a 400 strike. I'm short December, the 405 strike at $1. Okay. Now I expect this stock to go up because I'm buying calls. Right? Instead, the stock goes down from 400 to 395. Okay, so where am I? Well, the 405 call that I sold for $1 is making me a little bit of money. So let's say that I buy that back at 25 cents and I make 75 cents at it. Now what I do is I sell the 400 call the next week out for $1. Okay, so at that point, what I'm long is a 400 call out in January and a 400 call, the same strike now, not the 405. Now I'm at the same strike at 400, so I'm short one of those at $1. So what I've collected is $1.75. Okay. Now that isn't mitigating my entire loss that I'm having on the $5 option. Okay, but it's mitigating some of it. So in this case, say that the option falls. The $5 option that I purchased, it falls to 250. Okay, listen, I'm not willing to lose any more money on that long call than $2.50. So I'm going to cut that out. I lose $2.50 on that February 400 call that I bought. Now I'm also short the 400 call, and it's also, since the price has dropped, it's also dropped down to a quarter. So I sold it for $1, so I made 75 cents. So I sold two options, and I made 75 cents on both of them. Okay, so I made $1.50. Okay, now I lost $2.50 on the long dated call. So I'm still losing money. I've lost $2.50, but I've made $1.50. So I've lost a total less than $1. But, and here's the thing, when I say mitigate, not eliminate, you're 60% better off than if you just had the 400 call position alone and lost $2.50. In this case, you've only lost $1. Okay, so I'm not talking about eliminating losses trading. That's not possible. But you can mitigate how big the loss is by selling some short calls against your position. Okay, because they're going to go down, but they're not going to go down dollar-wise as much as your more expensive long-dated call is going to go down. So you're making a little bit, losing a little bit more is the scenario.
All right, so let's go, Joe, let's take them through your target zone option program. Everything that comes with the program, and then the great offer that we've got. And remember, folks that stick till the end, you're going to you'll be rewarded with the educational package that we do have for you. So what you receive, all right, with your membership to Trading's Target Zone Options, you get direct access to Joe and his team right? So that's email, phone, or Skype. Any trading questions that you have regarding the markets, the methodology. You do get direct trade alerts to your email and or cell phone. All right, so those are obviously very timely, give you all the information you need to execute the trade or exit the trade. And the daily recaps, all the trade updates, what trades you're in, what trades have been closed, what new trades have been opened, and so on. All the education surrounding the methodology, describing the entry rules, the exit rules, the money management rules. And then you do a daily video, Joe, and you talked about this earlier. You do a daily video that's sent out. I watch it just about every night that I can. You're going over the markets, seeing what's going on. You're talking about current positions that you're in. And anything you want to add to that. I know you like doing that, and it's like I said, great learning tool for our subscribers.
Yeah, I would just say on that the purpose is multifold. It's one, to try to help people help themselves. So I will go through things. Okay, here's how I set up this chart, and here's what I look for with ADX, and so forth like that, or even just, like, people underestimate the value of a straight line. Here's where resistance is here, and I show them how I figure where support and resistance is based on market memory and things like that. So I try to help people help themselves, or being able to look at their own charts. And I do tell them, what I think is going to happen, short term. And sometimes that's sometimes the best advice is to, guys, sit on your hands for a bit here, because it doesn't appear to be a great market for being too aggressive. And sometimes I'll say, hey, listen, this is an opportunity here to put out at you, and here's how I would handle it.
All right, excellent. And you do get access to third-party registered brokers. This is an option for those who don't have the time to execute these trades. So if this is something where you own a business or you're working or whatever, you can't be there to execute the trades, you do have access to third-party registered brokers that can execute these trades in your own account on your behalf. And then finally, you get access to us here at FFR Trading and our team. Our goal is to build you a well-rounded portfolio that is diversified among different traders and different strategies in different markets. That way, it helps smooth out that equity curve. All right. We're looking for 10 new subscribers, right? We can't take everybody. And the reason being, or one of the big reasons, is we can't have everybody taking the same trade. That can show up on the big bank's radar, and they can trade against that. So we do limit the number of members that we can take on to target zone. One of the things that we're going to ask you is, when you become a partner with us here at FFR through the Target Zone Option Program, is you provide us with your story, right? And we're just looking for, hey, I found FFR this way. I got involved with Joe Duffy, and, here's what happened from there. The second thing we're going to ask you for is your brokerage account statements. We want to use your account statements, basically, first of all, to monitor and see how you're doing, make sure you're on track, but also so that others can see how our clients are doing in these programs. Obviously, we redact all the personal information on those. You do have to commit to a quarterly meeting, right, with your strategist, so they can make sure you are on track. If you're not, maybe some changes need to be made to get you back on track, whatever needs to be done there. And if you are having success, provide us with a testimonial. Let us know. And Joe, I know, and of course, provide referrals. We get a lot of business through referrals because we have a lot of satisfied customers. And Joe, I know you work closely with your subscribers. I know some that have contacted me in the past, and you've taken their phone calls. So anything you want to add on that end of it in terms of support with your team?
No. You know what? People can. The easiest way to get in touch with me during the day is usually Skype. It's sort of like a text. They accepted a pop-up on my workstation. So yeah, I don't mind subscribers with questions, or I can't give specific advice tailored to each person, but I can certainly give hypothetical advice on a situation such as I did with the TLC.
All right. All right. Here's an example of one of Joe's satisfied students or clients here. And I'll just point out this is from John Linhart. And he said, with the Target Zone Options program, I get a nightly recap video. That's the video we were talking about, with graphs and live audio commentary by Joe himself. That explains what he's doing in the market. I like to know where my money is going and why. This is an invaluable tool, and I know what to expect in the following market session. So again, just a kind of a testimonial, not only to the effectiveness of the program, but the educational aspect of it as well. Up here he says I've made nearly $45,000 in just my first 2 months of trading with Joe's Target Zone. So this is the deal that we have for you guys, and thank you for sticking to the end. Again, you will be rewarded for the first 10 members only. Okay, again, we have to limit the size of these programs, because of the reasons that we talked about. If you sign up for for Joe's Target Zone option program, Joe is offering a $1,500 sign-up credit towards the Target Zone program. If you sign up for Target Zone, you will receive the Quantum AI program that I showed you that was returning on average about 50% per month right now. You'll get that free for 1 year. All right, so a phenomenal deal for you. And again, anyone who attended this webinar, call the main office. I'll give you the numbers here in a second to request your free education package. It's worth about $350 from Joe and FFR. We just need to verify your attendance. So first 10 members, you got to call now. You get Target Zone with a $1,500 credit towards that, and you're going to receive the Quantum AI program free for 1 year. And call in. Feel free to ask questions of our strategists. They do need to speak with you, because they have to make sure this is a good fit for you, right? We're not trying to put people into programs that don't fit their risk profile, or the other things that we're going to look at. So we want to make sure it's a good fit for you. I'll put up the numbers here. You got to call us here at 800-883-0524. If you're outside the U.S., you want to use that 737-292-4425. You can always reach us at support@ffrtrading.com, and a strategist will get back in touch with you. So give us a call at one of those numbers. Again, we'll just go through the program for you. We'll go over the performance statistics since inception on these programs. Again, you're going to get a $1,500 credit towards Target Zone, and you'll get a complimentary year of the Quantum AI program for free. And if you saw the results, so just think about, what these programs would do. Everybody is here for a reason today. What brought you here today? What challenges or goals are you working toward in your trading journey? Are you looking for a way to increase your success rate, or reduce your risk, or learn a sustainable approach? You want to boost your IRA. Maybe you don't have time to execute these trades on your own. You could use the broker-assisted option. Whatever your situation is, give us a call. We can go through that, tell you what your options are, see if these programs are a good fit for you. If they are, and you're one of the first 10, you can get that $1,500 credit plus the Quantum AI program for free. We're going to leave it there, Joe. Thanks again for taking the time to share your expertise with us, and hope you guys found this session valuable. I know, and inspiring. I know the technical challenges, unfortunately, but I think a majority of the intent came through there. So again, special thanks to Joe for sharing his knowledge and expertise with us. And remember, our team here at FFR Trading is here to support you. Don't hesitate to reach out with any questions. All right, have a great day, everybody, and happy trading.